Mortgage rates have finally shifted, and homeowners are pouncing. Refinances are spiking, adjustable rate mortgages are making a comeback, and the housing market is showing signs of life again. But here's the catch, it's not as simple as locking in a lower rate. Today, we're unpacking the latest Mortgage Bankers Association data, exploring why ARMs are suddenly hot again, and breaking down what's next for homebuyers, homeowners, and investors. By the end of this video, you'll not only understand the numbers, you'll know how to actually use them to save money, reduce risk, and make smarter real estate moves in 2025. This is not a quick soundbite, it's a deep dive no one else is giving you. Let's get started. Let's start with the headline. Mortgage demand is booming again. The Mortgage Bankers Association's Market Composite Index shows that total mortgage application volume rose over 11% in a single week. That's one of the sharpest week-over-week jumps of the year. The fuel, refinances. Applications to refinance surged 23% week over week, hitting the strongest level since April 2024. They're also 8% higher than the same week a year ago. For context, that's the first time in months we've seen refis beating year-over-year numbers. Here's the kicker. The refinance share of all mortgage activity jumped from 41% to 46% in just 1 week. Nearly half of all mortgage applications right now are refis. That tells us homeowners are hunting aggressively for savings. The average 30-year fixed rate with conforming balances fell from 6.77 to just 6.67. Loan sizes jumped. The average refi loan ballooned to $360,000. Why? Because borrowers with bigger loans feel the savings more dramatically. A 0.1% rate drop on a $370,000 loan saves around $30 to $40 a month, or $500 roughly a year, and tens of thousands over the 30-year life of the loan. As seen in other refinance bursts, the average loan size grows significantly. Borrowers with larger loan sizes continue to be more sensitive to rate movements. This isn't just about people refinancing a $120,000 loan. It's people with $400,000, $600,000, even $700,000 loans moving quickly to grab savings. Those small percentage changes add up to huge long-term wins. Here's where things get even more interesting. Adjustable rate mortgages, or ARMs, are back. The 5-to-1 ARM rate fell from 6.06% to 5.8% just last week. That difference, nearly 0.1% below the 30-year fix, has suddenly become too tempting to ignore. ARM applications shot up 25% in a single week, making up nearly 10% of all mortgage activity, the highest since 2022. So why are people suddenly flocking to ARMs? It comes down to monthly payment relief. On a $500,000 home loan, the difference between a 6.67% fixed and a 5.8% ARM can mean hundreds of dollars in savings every single month. For households battling inflation, student loan repayments, and rising costs across the board, that monthly cushion can be the difference between making it or breaking it. An ARM gives you stability only for the first 5 years. After that, your interest rate adjusts to market conditions. If rates go down, you win. If they go up, you could be staring at payment hundreds of dollars higher than you planned for. This isn't theoretical. During the mid-2000s housing bubble, many borrowers took ARMs betting they'd refinance later. When rates spiked and homes values fell, they got stuck and millions lost their homes. Even earlier in the 1990s, audits showed that 50 to 60% of ARMs contained calculation errors, costing borrowers over $8 billion in improper charges. When you mix complex contracts with big money, mistakes happen. So if you're considering an ARM, here's the takeaway. They can be powerful tools, but only if you have a plan. That means knowing your financial horizon, tracking rate forecasts, and being disciplined enough to refinance before that adjustable period kicks in. Now let's shift gears to home buyers. Purchase mortgage applications just rose 1% last week. Nothing dramatic, but they're still 17% higher than the same week last year. That's a clear sign that buyers are re-entering the market, but affordability remains the elephant in the room. Yes, prices have weakened in some markets. Yes, rates have dipped just a tad, but in June, the median U.S. home price hit $435,000, an all-time high. That's not exactly cheap housing. To put that in perspective, the median household income in the U.S. is about $80,000. At today's rates, that means many families are stretching well beyond the old rule of thumb of keeping housing costs under the 30% of their income. Buyers are cautiously optimistic. They see rates dipping. They see more homes sitting on the market, and they want to get in before competition heats up again. But they're also hesitant because affordability is still very tough. This is why we're seeing modest weekly gains in purchase apps, not a full-on frenzy. The latest consumer price index report came in mixed. Tariffs pushed some prices higher, but other categories like energy and durable goods saw declines. That gave markets some optimism that inflation might be cooling again. As a result, the odds of a Federal Reserve rate cut in September improved. That's good for short-term borrowing, but mortgage rates don't move with Fed cuts directly. They move with long-term bond yields, especially the 10-year Treasury note. And here's the key. While short-term bonds rally, the 10-year yield held steady. Here's the translation. Mortgage rates didn't really budge. So don't make the mistake of thinking Fed cuts equals cheaper mortgages. Analysts are already warning, even if the Fed cuts rates later this year, it might not translate into substantially lower mortgage rates. Why? Because lenders price mortgages based on long-term expectations for inflation and risk, not the Fed's overnight rate. The MBA predicts mortgage rates will hover above 6.3% into 2026. Fannie Mae predicts an average of 6.4% in 2025, easing around 6.1% in early 2026. And Realtor.com and NHAB both see rates lingering around the 6.3 to 6.5% range. So if you're waiting for sub-6 mortgages, you might be waiting years. The more realistic scenario is what we see gradual easing, with small dips like this week creating refinance opportunities. Alright, let's boil this down into a playbook. Refinance if you're in the 7s and your loan is $300K or higher. Even a 0.5% dip could save you thousands of dollars. ARMs are back, but dangerous. Only use them if you're confident you'll refinance or sell them before the adjustment hits. Buyers, don't get paralyzed. Waiting forever for 5% rates could mean missing opportunities today. Instead, negotiate hard on price and use seller concessions to buy down rates. Track the 10-year Treasury yield. That's your best predictor of mortgage rate direction, not Fed announcements. And 5, think long term. A home isn't just about today's payment. It's about stability, equity, growth, and financial resilience. So here's where we are. Refinances are surging, ARMs are back in fashion, and buyers are tiptoeing back into the market. Mortgage rates dipped just enough to create excitement, but not enough to fundamentally change affordability. So if you're a homeowner, this might be your best window to refinance in months. If you're a buyer, small wins are possible. Just don't overextend. And if you're tempted by an ARM, know the risk and make sure you've got a backup plan. Real estate in 2025 isn't just about quick wins. It's about strategy, and the smartest moves happen when you understand the bigger picture. Now, I want to hear from you. Would you ever take an ARM in today's market, or are you sticking with the fixed rate loan no matter what? Drop your thoughts in the comments. I'll be replying. And thanks for watching. If this video gave you value, smash that like button, subscribe for more in-depth real estate breakdowns, and don't forget to hit that bell so you never miss the next market update. Until then, stay smart, stay savvy, and keep building your financial future. Thanks for watching. See you guys.